What if I told you that $10,000 is all you need to start building real wealth? Most people think investing is only for the rich. They think you need hundreds of thousands of dollars, a fancy broker, and a finance degree just to get started. But that is completely wrong. Today, I am going to show you exactly how to start investing with just $10,000. Step by step, no jargon, no confusion. So if you have been waiting for the right time to start investing, that time is right now. Let's go. Hey everyone, welcome back to the channel. If you are new here, this is the place where we break down complex money topics into simple, actionable steps. Today's video is for you. Whether you are a college student, a young professional, or someone who has been earning for years but never got around to investing, we are going to cover everything you need to know about starting your investment journey with $10,000. And at the end of this video, I am going to give you a simple action plan. So make sure you watch till the very end. All right, let's dive in. Before we talk about where to invest, let us talk about why you should start right now. Even with just $10,000, there is one concept in finance that changes everything. It is called compound interest. Albert Einstein once called it the eighth wonder of the world. And here is why. Let's say you invest $10,000 today, and you earn an average return of 10% per year, which is the historical average of the S&P 500. In 10 years, that $10,000 grows to approximately $26,000. In 20 years, it becomes around $67,000. In 30 years, it becomes nearly $175,000. You did not add a single extra dollar. Your money just kept growing on its OWN. Now here is the catch. This only works if you start early. Every year you wait, you lose years of compounding, and that cost is massive. So the best time to start was yesterday. The second best time is today. Now before you invest even $1, there is something super important you need to do first. And most people completely skip this step, which is why they end up in trouble later. That step is building an emergency fund. Here is the deal. Investments can go up and they can go down. The stock market does not move in a straight line. If you invest your only $10,000 and then suddenly face a medical emergency or lose your job, you will be forced to sell your investments at a loss. So before investing, make sure you have at least 3 months of your expenses saved in a simple high-yield savings account. If your monthly expenses are around $3,000, have at least $9,000 in an emergency fund somewhere safe and accessible. Then, start investing now, assuming your emergency fund is already in place, or if your $10,000 is specifically for investing. Let's move on. Okay, this is the part you have been waiting for. Where should you put your $10,000? I am going to give you 3 beginner-friendly options. Each one suits a different goal and risk level. Option 1, index funds via dollar cost averaging, best for beginners if you are a complete beginner. Investing in index funds through dollar cost averaging is hands down the best place to start. Here is how it works. Instead of investing all $10,000 at once, you can automatically invest a fixed amount, say $500 per month, regardless of whether the market is up or down. This strategy is called dollar cost averaging. Over time, it smooths out the ups and downs of the market. You buy more shares when prices are low and fewer when prices are high. It all balances out beautifully. The best part, you do not need to know anything about picking stocks. You are just buying a tiny piece of the entire market. For beginners, I would suggest starting with an S&P 500 index fund. These funds track the top 500 companies in America. Companies like Apple, Microsoft, Amazon, and Google. They have LOW fees, historically strong returns, and absolutely zero guesswork. Platforms like Fidelity, Vanguard, or Charles Schwab make it super easy to set up automatic monthly investments in under 10 minutes. You just need your social security number and your bank account details. Option 2, individual stocks for those willing to learn now. If you want a little more control and you are willing to put in the time to learn, you can invest in individual stocks. With $10,000, you can buy shares of good companies directly through platforms like Robinhood, Webull, or TD Ameritrade. But, and this is a big but, investing in individual stocks requires research. You need to understand what a company does, how much money it makes, and whether it is priced fairly. My advice, do not just follow tips from YouTube, Reddit threads, or random Discord servers. That is how people lose money. If you are going the stock route, start by studying companies you actually understand. Use their products, read their earnings reports, learn the basics of reading a balance sheet. For complete beginners, I would recommend starting with index funds first, and then slowly moving to individual stocks as you learn more. Option 3, high-yield savings and treasury bonds, safest option now if you are someone who absolutely cannot afford to lose even a single dollar. Maybe you are saving for a specific goal in the next 1 to 2 years. Then safer options make more sense. A high-yield savings account currently offers around 4 to 5% interest per year. It is guaranteed, Your money will not go down, and it is FDIC insured up to $250,000 for even better returns with full government backing. Look into U.S. Treasury bonds or I-bonds. These are backed by the U.S. government itself, making them one of the safest investments on the planet. The downside, inflation in the U.S. averages around 2 to 3%, so your real returns after inflation may still be modest. That is why, for long-term wealth building, you need options with higher growth potential. Now here is my personal recommendation on how to split your $10,000 for maximum benefit. If you are a beginner with a long-term horizon of 5 years or more, here is a simple allocation: 70% in an S&P 500 index fund. That is $7,000 going into a low-cost, well-diversified fund. This is your growth engine. Think Vanguard VOO or Fidelity F6. 20% in a growth or small-cap ETF. That is $2,000 going into slightly higher-risk funds that have the potential for higher returns over the long run. 10% in a high-yield savings account. That is $1,000 kept somewhere accessible as a short-term buffer, earning you 4 to 5% while you sleep. This simple split gives you growth, diversification, and safety all in one. Now, if you are more conservative or closer to a financial goal, shift more money toward the safer options. The key is to start with something and stay consistent. Before we wrap up, let me quickly run through the 3 biggest mistakes new investors make, so you can avoid them. Mistake number 1, timing the market. New investors often wait for the perfect time to invest. They say things like, "I will invest when the market goes down," or "let me wait for things to stabilize." Here is the truth. Nobody can consistently predict the market. Time in the market is almost always better than timing the market. Start now and stay invested. Mistake number 2, panic selling. When the market drops by 10 or 20%, beginners get scared and sell everything. This locks in their losses. Remember, market dips are temporary. If you are investing for the long term, a 20% dip is just a temporary sale on stocks. It is not a signal to run away. Mistake number 3, chasing hot tips. There will always be someone telling you about a guaranteed 5x stock or a sure-shot trading tip. Ignore all of it. If someone truly had a guaranteed way to 5x their money, they would not be sharing it in a Reddit post. They would be quietly doing it themselves. Stick to basics. Stay consistent. Let time do the work. All right, so let me give you your simple 3-step action plan right now. Step 1. Open a brokerage account on Fidelity, Vanguard, or Charles Schwab today. It takes less than 15 minutes. You just need your social security number and your bank account details. Step 2. Set up an automatic monthly investment of even $100 into an S&P 500 index fund. Consistency matters more than the amount. Step 3. Increase your contributions every time you get a raise. Even a 10% increase every year can make a massive difference over time. That is it. Simple, actionable, no excuses. The journey to financial freedom does not start with $1 million or even 100,000. It starts with a decision to take control of your money, to be consistent, and to be patient. $10,000 is not just a number. It is the beginning of your financial story. If you found this video helpful, hit the like button and share it with one friend who needs to start investing. It could genuinely change their financial life. And if you want more content like this, make sure you subscribe and hit the bell icon so you never miss a video. See you in the next one. Take care, keep investing, and remember, your future self is counting on the decisions you make today.